So this video is based on exchange rates, and it's looking at a floating exchange rate. So in terms of what a floating exchange rate is, well, to begin with, a floating exchange rate is a regime where the currency price of a nation is set by the Forex market. And what I mean by that is the market which is for supply and demand of all currencies. So in other words, a floating exchange rate is based on market forces, and it involves no intervention at all. Now, some examples of floating exchange rates in countries that have them are the following. So we've got the likes of the UK, the likes of Australia, Canada, the US, Japan, Chile. All of these countries are currently have a floating exchange rate. Now, that's not to say that other countries do not peg their currency or their exchange rate on these countries' currencies. So, for example, a lot of countries peg their currencies to that of the dollar. But the US itself has a floating exchange rate, so it's based on just the Forex market, and it's based on the supply and demand of different currencies and their currency. Right, so to begin with, if we set up a contextual example and we look at the pound, all right, so in the last couple of years, we've seen pretty big fluctuations of the pound, and that's because there's a lot of uncertainty since the Brexit referendum results. So as we can see here, pound slumps to 31-year low following the Brexit vote. Results from across the country suggesting that the Brexit camp were on the brink of declaring a referendum victory, seeing sterling down 10% against the dollar. And the reason for that is, first of all, like I said before, the uncertainty. We've not known what the EU deal was going to be at the time, and obviously since this all took place, we have got a deal now, and there is a little bit more certainty. But at the point, especially with the referendum results, nobody knew what Brexit was going to look like. There was a lot of concern, there was a lot of worry. There was a lot of speculators suggesting that actually the UK were going to suffer. There was a lot of forecasts that the UK would experience a recession because of it. And because of that, people started to supply their pounds to buy other countries' currencies. And there was less demand for the UK pound. So if we were to show this in a diagram, so let's imagine that we've got, at this moment in time, we're doing pound to the US dollar, and let's say it was £1 to 1.2 US dollars. All right. Now, all of a sudden, we experience the Brexit referendum result. So all of a sudden, you've got, for example, maybe US multinational firms, or you've got maybe other multinational firms, maybe you've got currency traders, maybe you've got investors, whatever it might be, those who've got pounds and are worrying about the pound itself and worrying about the UK's future might think, well, I don't really want to keep hold of millions and millions of pounds worth of this currency. So what we're going to do is we're going to supply it, and we're going to supply it to the Forex market. Now, when we're supplying it to the Forex market, obviously, if you're going to buy another currency, you have to supply the currency that you want to exchange it for. All right, so let's imagine that you are going to buy US dollars. Well, in order to buy US dollars, you have to supply the pound to be able to buy the US dollars. So what we can see there is, as the supply of pounds shift to the right because they're being supplied to the Forex market, we see obviously a depreciation of the pound. So in hypothetical scenario, we've got £1 to 1.2 US dollars, and now it's £1 to 1.05 US dollars. Okay, let's imagine. Now, so we've got this situation, but what we're looking at now is, well, okay, but how does this impact the US dollar, and how does this impact the diagram for US dollars? And that's what we're going to look at now. All right, so as I demonstrated before, we've got the supply of pounds increasing because people are supplying the pound to the Forex market. And let's imagine that they're thinking, well, okay, I don't want to have pounds anymore, so let's go to a more stable currency. And perhaps they're thinking the US dollar is much more stable than the pound at this moment in time. So what they'll do is then they'll go and they'll demand more of the US dollar. And what we'll see is an appreciation of the US dollar, and we'll see a depreciation of the UK pound. And you'll always get that relationship. If one depreciates against the other currency, then that currency will appreciate against the previous currency. And as we can have a look at the axis, it's really worth noting how the axis changes between the two diagrams. So we've got pounds in dollars and quantity of pounds, and we've got dollars in pounds and quantity of dollars. We've got our supply and demand of pounds, and we've got our supply and demand of dollars. And we can see that if we're looking, because when we're looking at an exchange rate, we're looking at the conversion of one currency into another currency. So we're going to be looking at two countries and their two currencies. And we can show that really, really well via a side-by-side diagram like I've shown before. So if there's going to be a supply of pounds to the Forex, the reason for that is because they're wanting a greater quantity of another currency, and in this case we've got US dollars. So the first diagram, we've got the quantity of Q1 to Q2 going to the Forex market, and then in the next diagram we've got Q1 to Q2 of US dollars, but that is going to the person or the firm or the trader who is doing the initial transaction. Okay, so the reasons why you'd have a floating exchange rate and the benefits attached to a floating exchange rate. To begin with, there's no need for currency reserves. I mean, you'll clearly still have currency reserves, but there'll be less need to use them because you're not managing it, you're not manipulating, you're not fixing the exchange rate, and that's where reserves are needed. So therefore, there's less expense if you just allow it for the Forex market and the market forces to dictate the exchange rate. Second of all, it I suppose frees up your monetary policy, because if you're managing your exchange rate or you're fixing your exchange rate, you will have to intervene, and that intervention is via monetary policy. And that might have an impact on your ability to use monetary policy for domestic reasons. So let's imagine that you wanted to possibly control inflation, and let's say inflation is increasing, and therefore what you'd usually do is you'd increase interest rates. But if you've got a fixed or a managed exchange rate, you might not be able to use interest rates in that same way, because if you increase interest rates, then straight away you're going to attract hot money inflows, which is going to appreciate your pound, and therefore that might impact what you're trying to do with your exchange rate. But if you just allow it for floating, you don't have to worry about that. You can just focus on tackling inflation. Another reason is in terms of it can contribute towards an automatic correction for a trade deficit. So if you're seeing that all of a sudden you're buying a lot from another country, and maybe it's because that the exchange rate is quite healthy with that other country. So for example, you can buy quite a lot with your money because of how strong your currency is towards that other currency. Well, if you're going to be buying that other currency's, if you're going to buy that other country's goods, you're going to have to buy their currency as well to buy that good. And all of a sudden that starts to strengthen their currency, and therefore auto-corrects, because now it means that actually it's not as attractive as it was before. So you're not going to be buying as many of those goods as you did previously. So it kind of balances it out and makes sure that another country doesn't always have that unfair advantage because of their exchange rate. Now another we've also got issues with a floating exchange rate, and that's to do with the volatility and I suppose the uncertainty which can be attached to market forces. You can be susceptible to economic shocks. All right, there's factors that are completely out of your control, and it might be to do with something that's happening in a trading partner, their country. It might be to do with something that's happening in your country that wasn't expected or just wasn't accounted for. But that can cause quite a lot of problems for UK firms, let's say, who do depend on imports, who do depend on exports. And it means it's really hard to plan for if there's quite a lot of volatility. Now, so for example, in the last 5-6 years, when we're looking at Brexit and the impact it's had on the pound and all the trade talks and everything else, it has been quite volatile. It has been up and down in terms of the pound, and therefore when you're dealing with other currencies, that can be quite hard to plan for, because your costs are based on that exchange rate.